Silver just crashed 40% in 72 hours, $150 billion evaporated. And while retail investors panic sold at $75, institutions were covering shorts at the exact intraday bottom. This is not volatility. This is wealth transfer in real time. And what happens in the next 30 days will separate those who understand this game from those who are being played. Welcome to Market Flux. If you're new here, subscribe right now. Because what I'm about to break down isn't being discussed anywhere else. While mainstream media calls this a correction, I'll show you exactly what Wall Street doesn't want you to see. Here's what actually happened. Silver opened January 2026 at $70 per ounce. Within 29 days, it exploded to $121. That's a 73% gain in 1 month. But on January 29th at 10:30 a.m. Eastern Time, 3 hours before any Fed announcement, silver began collapsing. By January 30th, it had plunged to $75. A 38% intraday crash, the biggest single-day collapse since 1980 when the Hunt brothers' manipulation was exposed. Gold fell 12% in the same window. This was a Six Sigma event. Statistically, it should happen once every 1.4 million years, but here's where it gets interesting. The crash started at 10:30 a.m. The Kevin Warsh Fed chair nomination. The event everyone blames was announced at 1:45 p.m. 3 hours and 15 minutes later, silver had already dropped 27% before that announcement even existed. Let me explain what really triggered this. Think of the silver market like a seesaw. On one end, you have physical silver, the actual metal people hold. On the other end, you have paper silver futures contracts traded on COMEX and the LBMA in London. For decades, the paper side was 350 times heavier than the physical side. That means for every 1 ounce of actual silver, there were 350 ounces promised on paper. This system worked because of one assumption: nobody would ask for delivery all at once. In early January 2026, that assumption shattered. Between January 1st and January 7th, 33.45 million ounces were withdrawn from COMEX for physical delivery. That's 26% of registered inventory in 7 days. The seesaw was tilting. Then the CME Group stepped in. On January 29th, they implemented a new margin system. Maintenance margins jumped to 15% for standard positions and 16.5% for high-risk accounts. Previously, traders controlled 5,000-ounce contracts with minimal collateral. Now they needed massive capital. This created what's called a margin trap. Leveraged speculators who bought silver at $100, $110, $120 suddenly faced margin calls. They had two choices: deposit more cash immediately or sell their positions at any price. Most chose option 2. At the same time, silver lease rates exploded to 8% annualized. Lease rates measure how much institutions will pay to borrow physical silver in normal markets. This rate sits at 0.3% to 0.5%. At 8%, it signals one thing: the market is desperately short on physical metal. Here are the 3 reasons this happened. Reason number 1, China reclassified silver as a strategic material on January 1, 2026. They placed it in the same category as rare earth elements. Exports now require government licenses. Only 44 approved firms can export. Minimum annual output requirement is 80 tons. This cut global silver supply at the source. China produces roughly 15% of the world's silver. That supply is now controlled by Beijing, not the free market. The fragmentation was immediate. Shanghai silver prices traded $5 to $8 higher than COMEX prices in early February. Reason number 2. The LBMA, the London Bullion Market Association, has a credibility problem. In 2021, they overstated silver holdings by 3,300 tons. They called it a calculation error. By 2025, their eligible stocks had shrunk to 155 million ounces. Annual floating demand is 900 million to 1.2 billion ounces. Do the math. That's a 5-year supply deficit of roughly 164 million ounces per year. The LBMA cannot meet demand with current inventory. And when January's delivery requests surged, the system cracked. This is why lease rates spiked. There isn't enough metal to go around. Reason number 3. Industrial demand is accelerating faster than mining supply. Solar panels use silver. Electric vehicles use twice as much silver as gas cars. Each EV requires 1.3 ounces. US EV sales jumped 20% from 2024 to 2025. Global EV market is projected to hit $4.93 trillion by 2032. Data centers need silver for cooling systems. Nuclear reactors use silver in control rods. The renewable energy transition alone is creating structural demand that mines cannot match. Fresnillo, the world's largest silver miner, just cut 2026 production guidance from 45 to 51 million ounces to 40 to 46.5 million ounces. Hecla Mining expects 15.1 to 16.5 million ounces in 2026. That's below 2025 output. New supply is not coming online fast enough to meet industrial acceleration. This is a supply-demand imbalance playing out in real time. Now let me show you the disconnect between big players and retail investors. While retail investors were buying silver at $110, $115, $120, institutions were quietly building short positions. CFTC data shows commercial traders, banks, and large institutions held massive short positions going into late January. When the CME raised margins, retail got squeezed out. Institutions with deeper pockets and inside knowledge of the margin changes covered their shorts at the bottom. JP Morgan allegedly closed a huge silver short position at the exact intraday low on January 30th. The same day HSBC systems went offline. The same day the London Metal Exchange went dark for hours. This isn't conspiracy, it's mechanics. The U.S. Department of Justice and CFTC previously fined JP Morgan $920 million for manipulating gold and silver prices between 2008 and 2016. That's not speculation. That's court record. Wall Street legend Peter Brandt and former JP Morgan strategist Marko Kolanovic both warned of a 50% crash in silver before it happened. Then, immediately after the crash, both flipped bullish. Why? Because they understood what retail didn't. This was not the end of the silver bull market. It was a forced liquidation of leveraged positions to reset the paper market while you were being told to panic. They were positioning for the next leg up. Here's what mainstream media won't tell you while the paper price collapsed. Physical silver dealers reported record demand. Premiums over spot price surged. Delivery delays extended to 4 to 6 weeks. Retail buyers flooded in at $75, $80, $85 because physical buyers understand something paper traders don't. The long-term thesis has not changed. Silver is still in a structural deficit. China's export controls are still in place. Industrial demand is still accelerating. Central banks are still accumulating, and the paper market just flushed out all the weak hands. But here is where most people completely miss what comes next. Let me take you back to March 2020. Silver was trading at $12 per ounce. COVID lockdowns hit. Industrial demand collapsed. Paper markets panicked. Silver fell to $11.77 on March 18, 2020. Then something interesting happened. Physical demand exploded. Premiums jumped to $8 over spot. Dealers sold out in 48 hours. And by August 2020, silver had surged to $29, a 146% gain in 5 months. The pattern was identical: paper crash, physical shortage, price recovery, followed by a multi-year bull run. By May 2021, silver hit $28 again, then consolidated for 3 years before the 2024 to 2025 breakout that took it from $22 to $121. History doesn't repeat, but it rhymes. The current pullback to $75, $78 mirrors that March 2020 reset. Leveraged positions flushed, physical buyers accumulating, and a structural supply deficit that never went away. Here's what hasn't changed: central bank buying continues. The World Gold Council reported record gold purchases in 2025. But what they don't publicize is the silver accumulation happening behind closed doors. China's State Administration of Foreign Exchange doesn't report silver holdings separately, but import data tells the story. China imported 6,200 tons of silver in 2024. That's up 18% from 2023, and January 2026 import data released February 7th showed another 520 tons, annualized. That's 6,240 tons. They're not slowing down. The supply deficit is structural. Global silver mine production is 822 million ounces annually. Industrial demand is 575 million ounces. Investment demand adds another 300 million ounces. That's 875 million ounces of demand against 822 million of supply, a 53 million ounce deficit. Recycling adds roughly 180 million ounces. But industrial recycling rates are dropping because silver in electronics and solar panels is difficult to recover economically. Net deficit is still 25 to 30 million ounces per year, and it's widening. COMEX registered silver inventory hit a 5-year low on February 11, 2026. Only 58.3 million ounces remain in the deliverable category. That's down from 92 million ounces in December 2025, a 36% drop in 60 days. If industrial users and investors demand physical delivery at even 10% of open interest, COMEX cannot fulfill contracts. This is why lease rates are elevated. This is why premiums are high. The physical market knows the paper market is unsustainable. Now let me give you a prediction on the record. Screenshot this. Silver will close above $95 per ounce by March 15, 2026. And it will test $115, $125 by April 30, 2026. Why? Because the March COMEX contract expiry creates a delivery squeeze. There are currently 1,200 active March contracts, each represents 5,000 ounces. That's 6 million ounces. Registered inventory is 58.3 million ounces, but only 40% is typically available for immediate delivery. If 30% of March contracts demand physical settlement, that's 1.8 million ounces against 23 million available, manageable. But if April and May contracts also request delivery, the math breaks. The system will either force cash settlement or the price will spike to reduce demand. Let me walk through 3 scenarios with probabilities. Scenario 1. Silver consolidates between $75 and $85 through late February, then breaks above $90 on March 1st to 5th as March contract holders demand delivery. Probability 60%. This scenario assumes institutions let the market reset naturally, no intervention. Physical demand continues, paper shorts cover gradually, and the structural deficit reasserts itself by mid-March. Price target by March 31st is $95, $105. Scenario 2. Silver drops below $70 in the next 10 days, tests the 90-day moving average at $66, triggers stop losses, then reverses violently on extreme physical demand. Probability 25%. This scenario happens if another coordinated margin hike or unexpected macro event shakes out remaining leveraged positions, but below $70. Industrial buyers step in aggressively at $65. You're below mining costs for 40% of producers. That's unsustainable. Scenario 3. Silver breaks above $85 immediately, skips consolidation, surges directly to $100, $110 on short squeeze. Probability 15%. This is the low probability, high impact scenario. It requires either a major supply disruption or a policy announcement that spooks paper shorts. For example, if China expands export restrictions to include copper and aluminum, markets will front-run silver restrictions, or if the Fed signals rate cuts earlier than expected. Dollar weakness accelerates precious metals. Either event creates a cascade. Now let me give you practical takeaways based on who you are. If you're holding physical silver, do nothing. You bought metal, not a trading position. The long-term thesis is intact. Your silver still exists. Price volatility doesn't change ounces owned. If you're underwater at $100 or $110, dollar cost average down if you can. Buying at $75 reduces your average cost. If you bought 1 ounce at $110 and buy another at $75, your average is $92.50. Recovery becomes much easier. If you're using leverage or trading futures, manage your risk immediately. The CME can change margins again without warning if you're already leveraged. Reduce exposure to 50% of your maximum margin capacity. Volatility will remain extreme through March. If you're sitting on cash waiting, start scaling in now. Don't wait for $60 or $65. That level might not come. Split your capital into 3 tranches. Buy 1/3 at current levels, another third if silver hits $70, $72, final third if it drops below $68. If you're trading options, implied volatility is elevated. Selling covered calls against physical holdings can generate income. But don't sell calls below $90 with March or April expiry. You'll cap your upside if the squeeze happens. Here's what to watch going forward. First, watch the dollar index. Silver moves inverse to the DXY. If the dollar breaks below 95, silver accelerates. If DXY holds above 100, silver consolidates longer. Second, watch COMEX registered inventory, updated daily. If it drops below 50 million ounces, the delivery squeeze intensifies. If it stabilizes above 60 million, pressure eases. Third, watch the gold to silver ratio, currently at 65:1. Historical average is 60:1. When this ratio drops below 60, silver is outperforming gold. That signals the next leg of silver's bull run. Fourth, watch lease rates on the LBMA. If they stay above 5%, physical shortage persists. If they drop below 2%, the immediate crisis is over. As of February 13th, they're at 6.8%. Still elevated. Now let me tell you about 3 types of people watching this video. The first type is panicking. They bought at the top, they're checking prices every hour. They're reading headlines that say silver is crashing forever, they will sell at the bottom. The second type is frozen. They don't know what to do. They're waiting for someone to tell them the right answer. They'll miss the recovery entirely because they'll only act when silver is back at $110. The third type is learning and preparing. They understand that volatility creates opportunity. They know the difference between price and value. They're positioning now while others panic. Which type are you? Here's the bigger truth. Markets don't create wealth, they transfer it. From the impatient to the patient, from the uninformed to the prepared, from those who react emotionally to those who understand mechanics. Every major bull market has violent corrections. Gold crashed 30% in 2020 before surging to all-time highs. Bitcoin fell 87% in 2018 before rallying to $69,000 in 2021. Silver dropped 50% in 2021 before starting this current bull run. The question isn't whether silver will recover. The question is whether you'll still be holding when it does. Remember what I told you at the start, while retail panic sold at $75. Institutions covered shorts at the exact bottom. That wasn't luck. That was understanding the game. And now you understand it too. If you found value in this breakdown, hit the like button. Subscribe if you haven't already. And share this video with someone who's panicking about silver right now. Drop this exact phrase in the comments, I'm preparing, not panicking. Let me know you're the third type. And I'll see you in the next one when silver breaks $90.